I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Today's episode was a joy to make. It was a face-to-face meeting that crackled from the moment my interview walked through the door and shook my hand all the way through to a swift exit to a pressing engagement. As I was tidying cables and packing away my microphones back into their case, I already knew this was going to be a really strong episode. Now that I've had a listen back for the final run-through, I now know that to be the case. They say the best leaders embody their businesses, and if that's true, Howden should be absolutely buzzing along, because this encounter with that business's CEO, Tim Ronda, shows someone bursting with confidence, smarts, charisma, energy, and something else that we don't see so often, genuine happiness. Tim is clearly enjoying himself in this role. The podcast covers all the issues of the day in the reinsurance market and quite a lot more besides. Discussions about M&A, casualty, AI, and even the competitive reinsurance broking landscape all make an appearance. Also, despite running a reinsurance broker that has reached such a size and scale that it can no longer be referred to as a challenger and is still growing at pace, Tim doesn't tend to engage that regularly with the media. Given what you're about to hear, I think that's probably a mistake. But I'm also grateful that Tim's given the Voice of Insurance an outsized allocation of his rare media time. As the nights draw in, I can highly recommend this episode as a warming and energising tonic. It'll bring you right up to date and put a smile on your face and a spring in your step. Enjoy the podcast. Tim, welcome back to the Voice of Insurance.
Hello, Mark. Good to see you. This time in person rather than on video.
Yeah, it was so good. It's so much better to be in person. It's a bit cold in London and a bit grey. Very archetypal London day. If anyone who's never been to London would imagine it to be a slightly foggy, grey London day with the sun is sort of drizzling behind some clouds. But it's far better to be face-to-face, absolutely. And it was just over a year ago. It would have been pre-Monte Carlo last time we spoke. And I don't know if you ended up regretting this because it got quoted widely. But you said Howden was growing like a weed, you said, and you were about to hit $600 million in revenue, which is incredible. Another year later, where have you got to?
It's good. One, I really enjoyed being with you. And actually, it's gotten to me listening to the podcast in general, which is great. I regret using the word weed.
Well, yeah, no, you should have said mighty oak.
You're going to have to come up with some other word.
Giant sequoia laying down something permanent forever. You know, the problem with the weed is that they tend to die off at the end of the year.
I think that's right. No, it's been great, Mark. As we sort of discussed, I mean, I sort of think about Howden is really more being a story about our clients than about us, right? And we spent a lot of time trying to attract talent around the globe by region and by product where we didn't have it before. And that's sort of translated into 650 new colleagues in the last 3 years at Howden. So I think our story really is the people that we've accumulated, how they can impact clients, how they can help clients grow, how they can give a different type of client service to clients. And then the byproduct of that is that we then have some revenue growth that's associated with it. So to be honest with you, it's sort of the last thing, right, rather than the first thing that we sort of think about as we compile talent within Howden. But the good news is it's working. As you know, I joined Tiger Risk in 2021 pre-Howden, and it's been a lot of change since that time. It's been a fun 4 years.
Yeah, I remember when that was launched. It probably wasn't called Tiger on day one. It was kind of very quite generic kind of name, and I can't remember the name of it.
I believe it was originally called Alpha.
That was it, Alpha.
And the founders of Alpha got a nice letter from a Alabama-based company also called Alpha, and they suggested that they change their name.
Yes. Yeah. Well, Tiger's a nice name.
Well, and actually, obviously, the famous hedge fund legend, Julian Robertson, started the Tiger Funds. So Tiger Risk was always referred to as Tiger Risk because they didn't want to be a patent infringement as it relates to the hedge fund Tiger.
It's nice, but you saying about being people first, and then the numbers will probably look after themselves. Just get the right people.
I think that's right. It's not that hard. You get the right people that have market relations, that are innovative and creative, that are looking to do things differently. It's going to attract people.
But we've been kind of educated over the last 20 years to think that, from particularly the very large brokers, to say, this book of business that we have is corporatized. It is institutionalized, I think they would describe it.
Yeah.
This is not moving. This will be our account forever. But of course, it's not actually their account, is it? Back in the 1950s or the 60s or 70s, broker could move their book of business around. Maybe if they've got a niche specialty these days, you're still saying it can still move with the person saying, I really want this person to place my business. I don't want anyone else doing it.
I think that service standards really matter, right? And if you think about the thing that we're growing most in right now, it's more complicated, either national or global insurance companies that have multiple products. And when you're a reinsurance broker and you're having conversations with those clients, it's different than talking to the owner, founder, entrepreneur of their own MGA or of their own capital light balance sheet. In that, in one case, there's one or two people making the decisions as it relates to the risk management and the reinsurance strategy. For some of the larger companies, you're dealing with a CEO, you're dealing with a CFO, you're dealing with a CUO, you're dealing with a product line lead. You've got people in the seated reinsurance department. So for some of those companies, you need to have 7 or 8 people agreeing that your approach is the right approach. For some of the clients that we have, there's 1 or 2 people involved. So it's the same strategy, but it's a little bit of a more evolved process. And the honest answer is with those companies, they're really sophisticated businesses and you need to have leading talent in region and in product. So that's what we've been looking at.
So it's a bit of both. You need the infrastructure. Because so yes, if that broker has always been placing that program for 100 years, jumped and started their own reinsurance broker with no infrastructure, then they'd say, I'm sorry, we can't move that. That will stay institutionalized. But of course, if they move to you, you've built all the infrastructure. You've got no reason not to allow that to move because I really like this guy. He knows my business inside and out and I trust him implicitly and all the other things.
Yeah.
And he's come through for me when there was a gray area claim that was massively important to me.
That's right.
And all those things that are not tangible, they're important.
And Mark, it's funny with us, if we had a crystal ball, nothing's turned out the way that we originally planned. So you get the right people, you bring good ideas to people, and it turns out things happen that are not originally planned, but you're really quite happy about. And I think that's where it's gone. I mean, we just try and put good ideas out there. And if we have good ideas out there, we're hoping that people are going to choose to do business with us.
Yes, things don't always work out how you expect, but of course you take stock regularly and you say, right, that's good, we'll carry on doing that. Then that didn't work out the way we wanted to. When you're looking at your global business that you've constructed, are there any holes or gaps that you think, wow, we still need to have a clear intention to fill that gap? Or do you think you've done?
I think so. And I think it's not going to be for us in the next 12 months, but it's more in the longer term. We've got a great business in Brazil, and we've recently attracted someone to think about our Latin American strategy. For Howden Re, that could be built out more deeply over time. We don't currently have a strategy in Canada. It's a large market. Lots of really talented people. Big country, attractive alternative for us. There's an amazing business in the United States for US mortgage credit. Being a UK company, it's not the right time for us to be competing for US government contracts, but it's a great business. And it may be a business as Howden evolves over time, that if we think that we have an ability to actually give some advice and to be relevant, that we would love to do it. But
I think because the US government's sort of in the mortgage business, isn't it, with all the different quasi-states?
It's an amazing business. I mean, Fannie and Freddie have to buy some risk mitigation products, and they buy some in the capital markets, and they buy some reinsurance products. And it's been amazingly profitable business for reinsurers, and it's been a great business for reinsurance brokers. So those would be 3 examples that fly off my head where we're not involved right now. But I think the good news is
but you could be.
We've got most of the products and geographies covered. So if a client calls us and they say, I have a problem in Taiwan, we could bring a couple experts in and help them with the problem in Taiwan equally as we could in Prague, equally as we could in the United States.
So you feel pretty satisfied that most of it's done.
I think that's right. I mean, listen, we're an evolving business.
It's never done.
We're never done. One of the things that I think that we've really benefited from that I think our clients like is we're a melding pot of a bunch of different people. So some people come from one broker, some people come from another broker. So we're constantly challenging ourselves as to what is the best of everyone's experience and how do we bring the best of everyone's experience and create a better client experience. So I think ultimately, we love bringing in people from outside the firm. We also love developing people from inside the firm, but we love bringing people outside the firm because they always have some fresh ideas for us. So I think that will never stop. I mean, we're going to be challenging ourselves constantly.
Someone comes in and says, why the hell do you do it that way? You're all crazy.
That's right.
Said, oh, right. There's another way of doing it. And it says like, yeah, well, it is better. It's like, good. Well, if it wasn't for you, we'd still be doing it the dumb way. I didn't realize you could do that.
I think you're right.
You've got people in Taiwan, you've got people in Prague. Where's good and what kind of lines? The market's in flux at the moment, so I bet that's changing.
The market's in flux, and we'll get to it, I'm sure, during the pod, but we still think it's an attractive market, both an attractive insurance market and an attractive reinsurance market where insurers can make money, reinsurers can make money, and brokers have capital by which they could bring creative ideas. So what's working for us? To be honest with you, we're growing everywhere. There are some businesses like our cyber business and our international treaty business where there's a smaller start. So the percentage growth rates are astronomical,
With not many actual dollars.
But meaningful dollars. But and then there are some more of our mature businesses like North America, where we're growing in a high percentage rate, but it's also a high dollar rate. And the thing that's fun about that is we've always been known for our analytical capability and a lot of property expertise. We invested heavily 4 years ago in some casualty and some professional lines expertise, not just in the US, but in the UK and around the globe. And pleased to say that of 31 new clients in North America in 2025, 24 of them are casualty and professional lines basis. So
wow.
We're picking up some steam and momentum there from the talent that we invested in 3-4 years ago. Like I said, the cyber team that was new 2.5 years ago are doing very well. Our international team is really starting to pick up some steam, both facultatively and from a treaty perspective. Our UK specialties team is growing very, very well too. And we've always had a love of and a specialty in both the binders and programs business. Yeah. And that business continues to expand fairly rapidly.
So it's pretty good almost everywhere that you survey then?
Yeah. I think there are some markets where original rate and additional net retentions are impacting things, like some of our businesses, like our facultative business. There's been a little bit more of a net retention, but the team's finding innovative new products to make up for some of the things that had previously been bought that are now being retained. So yeah. I would say we're quite pleased with where all of our businesses are right now in terms of their growth cycle.
You were probably the first person to coin this ahead of everybody else, actually, with this time last year. I'm casting my mind back to the podcast, and I think I ended up with the title. It was almost like, we can all be happy. One of these rare moments where we can all be happy. It's not like buyer and seller can both be reasonably happy, and which is a good place, and therefore the broker's going to be happy.
Yeah.
My read back from going to Monte Carlo, this is everyone's even more happy, a little bit more happy. That most reinsurers say, I can still profitably grow, and I'm happy to do so, but I'm kind of happy that I know I have to probably give a little bit more than I was giving this time last year, or certainly 3 years ago, but I'm kind of happy.
I think it's right. I mean,
happy to entertain more interesting ideas than I was before.
I mean, there are 3 parties to a deal. There's the original cedent, there's the reinsurer, and then there's the broker. And for the market to be fully functioning, it's got to work for all 3 parties, right? 2025 has been an interesting year. It's not over yet. So, we'll see what events could occur between now and the end of the year. But if you think about starting the year in January with the wildfires, which was a very material, probably a 15 billion plus ceded loss to the reinsurance world, wasn't a great start to the year. And I think a lot of those reinsurers and the conglomerates that are both insurance and reinsurance companies, when you look at their reported results, quite a strong 2025. And I think that's a nice reflection for both the insurance and the reinsurance world to think that the system's working. People are able to accumulate risk. They're able to hedge that risk. The people that take the hedge of that risk are generating enough profit that they could withstand an event or two that are natural and unexpected, but they do happen with some frequency, whether it's floods in Germany, or whether it's rain, hail in Italy, or whether it's wildfires in California, or whether it's your standard hurricane and earthquake or cyclone activity around the world. It seems like both the insurance and the reinsurance communities generate enough premium that they can withstand some of those shock losses and still find a profit for their investors.
Yeah. 3 or 4 years ago, of course, you could just renew your book. You can get 10% growth just for premium because the premium's going up.
That's right. I mean, if you were in 2023, you could probably reduce your exposure by 10%, charge 25% more in rate, and have 15% more premium. That's going to be more of a challenge in 2026. I think
I had a podcast with Mark Cloutier of Aspen. I think that ended up being the title. It's sort of like, we're still taking risk off the table. Back then, this is all ancient history. Absolutely now. But you already said it. We're not going to expect prices to be going up much from here. Maybe in isolated cases where they need to be, but in general, we expect slightly less premium for the same amount of risk in aggregate globally. Therefore, the onus is more on the innovation. But then the innovation's easier if you've got more client reinsurers who are willing to entertain. They've got their heads up for a change, looking at client, looking at you, saying, "Hey, what have you got for me?" Whereas before they had their heads down, so leave me alone. I just want to kind of sort myself out.
I agree. Insurers and reinsurers are going to be looking to grow in 2026, as they should do, right? They're making money. They want to make more money the next year.
And it's logical. Because the fundamental pricing is in a good place still, even if you knocked a bit off.
So how do you do that? You do more of the things that you like, and then you find things that maybe you didn't do in the harder market cycle because you didn't have to. And you start thinking about, what are some of the new things I could do that I think I can make money at? And I think that's where we're particularly focused at Howden Re, which is helping reinsurers, helping our clients think about growth ideas for new products, specialty products, better understanding of products that they're already in that maybe they could grow profitably in despite what will be some rate reductions in the market. And I think in 2026 and 2027, management teams at brokers, at insurers and reinsurers are going to earn their money because they're going to have to be selective and intelligent about where they choose to grow.
And obviously, the world's moved on. The last time a reinsurer looked at an aggregate deal was 5 years ago, and now they haven't had to because they said, no, I'm not doing that. I'm just going back to vanilla stuff. Thank you very much. No more weird stuff. Of course, now that risk is better understood. That risk has been passed back to that cedent. That cedent has re-underwritten that book, has had the benefit of a huge amount more data because they didn't used to have to think about that book. They used to just cede it and not think about it. And now they've thought about it, and they've had to concentrate their minds more financially. They're taking that risk on themselves. And they've got better data. And of course, the world has moved on. Technology is better than it was. Our understanding risk is hopefully better than it was 5 years ago, even 5 years ago. It sounds like, therefore, you have more fertile ground. We can write this profitably this time because we have a better understanding of it.
I had lunch with a major reinsurer yesterday here in London, and they reminded me that they sold aggregate all the way through the market cycle. The terms and conditions on the aggregate changed, right, as they learned and as they evolved. But in terms of selling a product, if the price was right and they understood the exposures, it was something that they were willing to sell throughout cycle. What I would say it's really interesting is you learn in every scenario. And I think a lot of really well-run insurance companies and reinsurance companies that were forced to take a little bit more of net retention learned that for some of the perils that aren't peak perils, like cyclone, hurricane, and earthquake, to think about how they price for that, almost like a fire loss. So obviously, a lot of our clients still would like lower retentions, and we're going to be actively seeking ways for them to see more volatility. But the reality is, I think that the business is in a much better spot in that people are much more sophisticated about pricing standard frequency cat than they were 3-4 years ago.
I was having a chat with a risk manager for a large corporate that had lots of exposure to Ukraine. And he was saying, well, the insurance industry just ran away, obviously, the day that the first sort of shots were fired. But they've handed me a load of business that has been in my captive, and it's been making my captive a lot of money. So I wasn't expecting to retain that war risk, but it turns out it wasn't as bad as the insurance industry thought, and I know more about it than they do now, but there you are. So yeah, when I do come back into the market, now that the market has completely changed, that we can have a different conversation, hopefully, about that risk, and now I think I understand it.
I think that's right.
Those are the sort of areas in the tidal zone, but somewhere between low tide and high tide, and this middle bit that gets wet sometimes, but not always. We're going to be finding that balance, and the balance is going to be closer to the water than it was before.
I think so. When something is commoditized and there's twice the amount of supply than there is demand, those are going to be the most challenged from a price perspective markets. There's still a lot of markets where supply equals demand. And I think that the people that execute on strategy are going to find those markets where their capacity is relevant and there's more of a supply-demand balance, rather than relying 100% on those markets where there's twice the amount of supply than there is demand.
When I talk to a lot of reinsurers, they would say, well, my strategy is far more holistic than it ever was. Is that really coming through?
I think it is.
I'm going to identify these top companies that I really want to reinsure because, one, that'll take care of my growth because they're growing profitably. Therefore, I hopefully will grow profitably along with them, particularly with the proportional stuff.
Yep.
But in those other relationships, they have a much clearer understanding of what they're ceding to me. And therefore, if they're empathetic, they would understand that I wouldn't deliberately write things below burning costs because I'm not crazy. And who would want to have a crazy reinsurer who writes things below burning costs because they don't want to be around for very long?
I think that's right. Listen, we're a highly analytical business. There's a lot of analysis done. I'm sure we're going to talk about technology. But the reality of the situation is fundamentally people will want to do more business with people that they've made money with in the past. And I don't see that changing, right? So I think that someone's strategy will be there are some companies that they've worked with for quite some time and they'll do more with them. Yeah. There are some people that used to work at companies that they used to do business with that are now somewhere else that might be doing something new and innovative. And they'll find a way to make money with them in their new environment. And I see this as a market where people see things as an opportunity rather than as a challenge. And I think that's a good thing.
Back on this point about it being a better market to remove pain, whereas before it was more a market that was happy to, realize that, sorry guys, I'm going to have to inflict some pain on you because this is not working. And now things are working again. When you're talking to those clients, what are those sources of demand that you're going to be associating? The things that are a pain that you want to be able to remove via reinsurance?
I think in an interesting way, reinsurance is best for those things that you have the least certainty over if you're an insurance company. So you sort of think about new products. I mean, cyber is not a new product anymore. In fact, cyber's been around for a while. There's a really much more robust and sophisticated modeling capability for cyber. I mean, 10 years ago, if you talked to an executive at an insurance or reinsurance company and you ask them what their 1 in 100 or 1 in 250 occurrence or ag is for their cyber book.
They'll just tell you what your net line is. That's
right.
all I know.
That's right. And I don't think anyone fully relies on all the property models. So no one fully relies and bases his entire capital structure on cyber modeling out, but it's getting more sophisticated and people are coming up with ways to sort of utilize it to make strategic decisions about how they allocate capital for the line. But I just use it as an example. The cyber product's been a really profitable product, even throughout losses. And I think as more losses come, more people are going to discover it. When we sort of think about where people have made a lot of money throughout cycle, there's a lot of specialty classes, whether it's political risk, trade credit, surety, cyber, some of the excess and surplus lines, financial lines, or casualty business, excess and surplus lines property. And there's a lot of money to be made in a admitted or commoditized commodity product. There are some insurance companies that do that exceedingly well and make lots of money doing it. But we still think that there's a lot of room to grow in the specialty space from both an insurance and reinsurance perspective.
And that specialty is going to grow faster than the rest of the market anyway.
Seems that way.
And what other things, if you can sort of have a magic wand and say, well, if I had a magic source of capacity that was good at doing this, what would it be? What's the problem that all cedents have got that they want you to solve? Just things that are just too volatile for me.
I honestly think there are very few unsolvable problems right now for cedents, right? So what are some trends that we're seeing? ILS activity, which has obviously had a huge amount of impact on the property business or the short tail business, is finding new and creative ways to enter the casualty space. So there's lots of conversations with clients about that. And I don't think it's because they're desperate and they have to consider the ILS product, but it's working, it's functioning. There's a viable market that seems long-term that is benefiting the entire market. That's a property ILS business. And I think people are interested in finding ways to bring more capacity than just the existing traditional reinsurance capacity in the casualty and professional line space. So that's an area where we see a lot of investor interest right now and a lot of client-based discussions over what form does that capacity take? How does that compare to other options that they have? I don't think it's necessary, but it's additive and it's helpful.
Yes, some of that seems to be on the legacy side, doesn't it? The casualty legacy.
I mean, as you know, we're a big believer in the legacy space. It's a really great way to shore up balance sheets and provide certainty, even if you're not in a scenario where you have to buy. We think that there's lots of scenarios where it is just intelligent to buy because it allows you to take certainty on your balance sheet for a legacy reserve issue and give that to someone else whose business is in fact taking that volatility. And obviously there's been a lot of capital inflow into that legacy space as well, which we think is fantastic.
Yeah, it's one of those things, isn't it? Ultimately, if you're there to help somebody optimize their capital, then you should do it in whichever way it can work.
I think that's right. There are some really well-run, really profitable and sophisticated insurance companies that look at legacy deals as part of their continual annual decision-making.
Yeah, and of course, everyone's different. Everyone's got different portfolios, so everyone has different accumulations of risks that they want to get rid of, and everyone has different appetites, and that's why it's so wonderful, isn't it? You know, that's why you have insurance, that's why you have reinsurance, that's why you have ILS, because it can miraculously work for everybody, and everyone could be happy again. You mentioned about obviously becoming a bigger player in the casualty space after that investment. It was probably, when I've come back from Monte Carlo, it was still the only segment of the market where anything property related, you'd say, yeah, there's a pretty clear direction of travel. We know that things are going to soften from here, but we're still happy. But with casualty, it's not clear whether everybody was still happy or not. And it just, of course, it was one of those ones where it depends, and it depends on who you talk to, how much legacy they had, how big were they in the softer period of the market, when did they time their re-entry into the market, etc. So it was a real kind of, it depends on who you talk to.
I agree.
Is there any emerging consensus, do you think?
No.
Good. I'm glad I was right. I didn't come away with the wrong impression.
I think it's healthy for the market. I think all those factors you just described are, in fact, the factors. If you work for a group that had a rough, long tail policy year 15 through 19, 20, maybe even 21, you're going to make different decisions over policy year 26.
You're never going to forget that, aren't you?
So you're probably going to be a little bit more conservative. There are some other people that didn't have that exposure. They get a bunch of smart actuaries. They look at rate change. They look at terms and conditions. They look at portfolio construction. Frankly, we're still seeing a lot of discipline around gross limits usage. In a soft market, if someone had $25 million of gross limit and we were put together a limits profile, 95% of their policies would be at the 25 million gross. In today's market, it's probably 8 to 10 on that 25 million gross. We're not seeing a huge amount of limit expansion yet in the marketplace. So I actually think if there's 30 reinsurers that sell casualty reinsurance, whether it's in the US, the UK, and Europe, around the globe, I think there's 20 different views amongst those 30 different reinsurers, whether it's by product, by class, by year, by cedant. And I actually think it's good for the market. Having people with a variety of opinion, I think is helpful rather than having everyone have the same exact opinion.
It's the best place to be if you're a stock picker, is when no one can agree on what the hell's going on. And you've got a clear idea yourself that you can test your thesis, because you can see that there are different ones. This one is better than that one. And I have a different view on this one.
That's right.
Oh, well, no one else seems to like that one. That's great. That means I can have that one.
Yeah.
Because I wasn't even being shown that one 5 years ago. I would never got anywhere near it because I'm a more recent entrant, etc. So to just have all those dynamics. So if you're braver, you're feeling smarter, you're feeling cleverer, or you feel like you've got a thesis that you think is robust, then you can go and test that thesis in the market, because you can actually be given a proper showing of business still, right?
I think that's right. I think there's a bunch of really intelligent people that you could give the same data set to, and you could have two very different opinions as to what those two very smart groups of people think about a data set that's long tail in nature. And I think that's what makes the world go around.
I'm old enough to remember that in the late 80s, there was this fashion for those crazy magic eye pictures. We had to kind of let your eyes go out of focus, and then you could suddenly see it was a dolphin.
Yeah.
And you suddenly get this revelation. Oh, it's a dolphin. I didn't realize. Yeah. There's like a whole load of kind of pixels.
Yeah.
But there's a bit like sometimes looking at those triangulation tables, you're thinking, yeah, maybe I need to let my eyes go out of focus, and then I'll see that it is a dolphin, and therefore I'll like it. Or it's a horrible gorilla, and I really don't want to go near it.
Yeah.
But it is remarkable. It is the most remarkable thing that people can look at the same set of data and see two different things.
I think that's right. And honestly, it's a world that we live in where there's a lot of around the world unrest, change in regulation, different judges and lawyers. So you can think you have everything right, and then you learn something new that you didn't know before, and either learn that you're making twice as much money as you thought or half as much as you thought. And I think that's what makes that casualty and long tail business so much fun, because it's an art as much as it is a science.
Something that often happens around this stage of the market, when the market gets a little bit softer and simple growth by just dint of being around doesn't come automatically anymore, is carrier consolidation. We've seen a little bit of that, and some of that, of these things, each deal specifically. I don't want you to talk about any specific deal at all, but talk about generally in the trend. Do you think we've fired the starting pistol on M&A becoming more of a feature day to day?
I do. I mean, obviously, Howden Capital Markets is an amazing tool for us, and obviously they're in every situation or a confidential scenario. There seems to be a lot of M&A conversation happening. And I think it's a logical thing, and I think it's actually healthy for the market, and that when you're doing a merger and acquisition, reserves would be something that you'd spend a lot of time on. And the last 3-4 years, I think people have done a really good job of building some confidence around those reserves. And that's just a natural way for growth, right? So whether it's a balance sheet buying an MGA, whether it's a balance sheet buying another balance sheet, if you can identify a company that's doing something very well, and they could see some value by partnering and becoming part of your organization, it's a fantastic way to get some inorganic growth and have that being done in a way that you think is maybe more profitable than either doing more of something you're already doing or starting something new. So I think now is the time where, in order to achieve growth levels for the next couple of years, M&A will have to be a part of a strategy.
You've also got, obviously, a big part of your business is that capacity building on behalf of different underwriting outfits. We've had that huge boom in MGA formation and in the excess and surplus lines market itself in terms of business flows there. And that hybrid carrier movement, which has been fascinating to follow. I've been following that and having all those people on podcasts over the last 5 years, and it's just been explosive what's been going on. You know, I interview someone in year one and then they got up to 300 million. By year three, they're in 3 billion. And it's completely crazy. Or now they're listed on the stock exchange. And it's like, wow, this is sort of El Dorado in some ways. Would you say that is also likely to have a consolidation moment? Because it tends to be the sort of thing where you've had explosive growth. Would it be logical?
I think it would be logical. I mean, the reality is people start a business. That business achieves all the goals and objectives that the original team had set out for themselves. And as they think about succession plan for their business, there are people that they work with that have become their colleagues and partners along the way, or there's an opportunity to get some liquidity on your original investment, having achieved your primary goals and objectives by joining somebody else. So I think some people will want to remain independent and find ways to sort of remain independent and kind of continue to do the thing and go from...
There's always a Howden, isn't there?
To go from...
You want to have the name above the door forever, right?
Absolutely. But I think that there'll be a larger variety of options for people. People can go from 1 billion to 3 billion and sell. People go from 1 billion to 3 billion and find some way to attract capital to keep the same team and go from 3 billion to 6 billion. But I think that the idea of MGAs or capital light is around forever, which is if investors can make a really good return by only making a $250 million investment, they'd rather do that in many cases than making a $2 billion investment and making a good return around that. So the idea of people to make a really good investment return off smaller bets rather than billions and billions of dollars of original balance sheet, I think is going to be around for a while.
So it's just a logical thing that's almost bound to happen.
I think that's right. I mean, there are a lot of entrepreneurs in our business. I hope there always will be a lot of entrepreneurs in our business. And for someone who's got an entrepreneurial idea, it's going to be easier for them to attract $250 million of capital than it is $2 billion.
Yeah, of course it is. And let's be fair, we've been a great home for entrepreneurs. You know, sitting in London, Lloyd's businesses have gone from 0 to billion in no time, done really well for themselves. Hybrid carriers all over the world, particularly in the States. MGAs doing great business. Right. And, you know, and brokers doing well too, reinsurance brokers also doing extremely well. I suppose I've got to mention, it's not an elephant, I don't know, it's a small elephant or something in the room. We all know, and we don't have to talk about names, but reinsurance broking is going to get even more competitive. So we believe, there are public statements to the effect that it will, and it as if it wasn't already competitive enough already. How are you going to deal with that? What's the strategy? Or do you just have to carry on doing what you're doing before? Right?
I mean, Mark, I wish I had a crystal ball. I mean, it starts with, we should get up each morning and think about all of our colleagues and sort of say, are they happy here? Are they happy with the responsibility that they've been given? Are they happy with their role with clients within the company? And if they're happy here, then I'm less worried about them being attracted to go somewhere else where they could be happier, right? But I think here's the reality of the situation. Clients like choice. And I think there's some great existing options out there. It would be arrogant for me to think that there aren't 3 or 4 other great ideas out there of new reinsurance brokers that could start, that have good ideas, that could provide choice to clients and provide a service that maybe the existing set of reinsurance brokers isn't providing. So I just think that's just the natural order of things. So from our perspective, our people are the most important things to us because they impact our clients, who are the most important thing to us. And we just get up in the morning and we sort of say, what is someone at Howden Re's experience like? Hopefully it's good. If it's not perfect, how do I make it better?
Never get complacent.
Because the reality of the situation is we have some really good people. And I'm sure that if you're starting a new reinsurance broker, you'd be calling our people. In fact, if they didn't, I'd be upset because that probably means we don't have the best pool of talent out there. So I think you have to be realistic, which is we have a good pool of talent. We've got some really great colleagues. They're going to get phone calls, and I hope that they like working here.
Yeah, and I suppose, and you're making it easy for them to do their job and be fulfilled here, give them all the right tools, everything they need to
be clear, I don't want their job to be easy. I want them to work really hard, but I want that hard work to be really rewarding.
But but you want them to feel that they're working smarter here.
Yeah.
I think that's the other thing.
For a cause, right?
Yeah.
For our clients, for each other, for the team. I think that stuff matters.
And getting all that right, the whole thing, including saying, I think I've got the best tech here. If I went somewhere else, I bet we'd have to go back to that crummy old system that was on the green screen, and that kind of stuff. It's completely holistic, isn't it? It's not just like I've got football and a cappuccino and I get neck massages in 2 weeks. It's everything, is it? We've got the best of everything here. I suppose it just spurs you on to keep doing it.
I think that's right. And listen, the laws of supply and demand are always going to exist. So if people have a demand for something that the current supply is not providing, then people are going to start up businesses. And I think that's healthy.
And you need to keep manufacturing your own talent because it keeps graduating every summer. It all graduates and you can get some of it.
That's exactly right.
Digital underwriting, I mean, everything's digitizing. Every broker's got a facility, there's smart follow. It's almost mind-bogglingly exciting time. It's like with a lot of these things, it's easy to get carried away and take it to some crazy logical conclusion that we're all going to be out of a job. But half the Lloyd's market is facilitizing.
Yeah.
What about the reinsurance market?
It's interesting, actually, listening to your pod. You've had a lot smarter people than me who are in the risk-taking business opine on this, and I actually generally agree with them. It's sort of like your own investments. Some people have a strategy that follows the S&P 500. Some people have a strategy that follows NASDAQ, and then some people select their own stocks.
Yeah.
Do I think it's really healthy, and is it logical that there's some facilitization of both the insurance and the reinsurance market? Absolutely. Because people could find a way to generate some premium and generate some profit in a quick and large premiumed way. I don't ever see it taking over the whole market because at one point, everyone's going to sort of say, I'm a better risk taker, and I understand that index is attractive, but I think I could be 200 basis points better than that index. And I think that's just the nature of competition, is the nature of our business. So it seems to me there's some ratio, and I don't know what's right. Is it 10%? Is it 30%? Right? But where the facilitization helps the market, and actually it allows people to generate revenue from that, as well as generate revenue from their own specific strategy, which they think is different and better than an average.
Yeah, and it's going to lower the cost of capital and the expense, so therefore you can sell more reinsurance.
That's right.
More actual reinsurance is doing the actual reinsuring rather than do all the frictional stuff.
Yeah, so I don't ever see a scenario where 100% of it is through facility, but I think we seem to be reaching a logical percentage that allows people to take advantage of it.
Do you think we won't be far away from seeing those kind of global reinsurance broker facilities? Not just, we're seeing a lot of specialty broker facilities in the London market, but then what about global reinsurance broking facilities?
I could see it happening. I think those facilities work really well when there's a real capacity need, where it's solving a client problem, more so than if it's a commoditized product where everyone is already selling it. So if everyone's already selling it and it's really easy to generate that capacity, there's less value for the client in that facility. Where I think the facility provides a lot of value is if the client really needs a source of capacity and you have to go to 5 to 10 people to generate that for them, rather than to just do it on an individual deal transaction.
Yeah. So somewhere where you can really bring a big pot of capacity to bear to a problem that really needs that capacity.
That's right.
Something that's got a smart
That's right.
understanding.
And even on an across the board facility, rather than just a specific product line or capacity need, it's a great way to attract investors that maybe aren't already in the space, which again, I think is healthy. So the reality of the situation is a lot of these people are really sophisticated corporate finance experts that don't understand underwriting, maybe in the same way that a 30-year Lloyd's underwriter understands underwriting, but they're interested in the space. It's a diversifying asset class for them. And they actually prefer a facility or an industry average because it's something they have a lot of data they can underwrite to, where they don't think they have the expertise to create the alpha on an individual deal by deal selection basis. I could really see facilities being a way, whether they're casualty or whether they're reinsurance, to attract more capital that's not currently invested in the reinsurance space into the reinsurance space.
Yeah, so like US liability reinsurance casualty vehicle sounds like a good thing.
Listen, if you are interested in the ultimate cash that you hold at the end of 10 years, writing some of these long tail casualty lines is a really interesting way to make a lot of money as an investor.
Absolutely. Obviously, and you do have the benefit of that compound interest while you're waiting as well. It's not too shabby at the moment, particularly in the US and UK bond markets. In fact, most of the others as well. Obviously, it's nice we're another year on from the kind of shock and awe and the hype of AI just sort of breaking out into people's consciences a couple of years ago. Now that we've got to the point where, this time last year, everyone said, well, I've got teams of people trying out different use cases and we're going to see what happens. Now that most people have already done that, what are you finding the ones that actually work that you're reinvesting in, and where are you getting the best productivity gains, for example? And obviously quality gains.
It's still a work in progress, I'd say, for us at Howden, as well as for us at Howden Re for our clients. Anything that we can do where we get faster access to data to allow people to make strategic decisions around the aggregated data is a win, right? So we're investing a lot of money right now into a casualty data lake. And anyone that is going to be listening to this podcast is going to laugh at me because I'm not a technology person. But the reality of the situation is we're trying to aggregate a bunch of industry data so that we could use AI to look at themes. So we can see if there are some themes that the top 25% of an underwriting class has that's allowing them to be the top 25% of profit versus the bottom 25% of profit, right? So I think where we're going to continue to use AI is how can we use data that's available to us, data that we have, in a better way so we can give our clients better advice over how they can make more money and how they can avoid scenarios where they may not make money. Do you know what I mean? So we can make it more complicated than that, but in reality, we're in the client business. So for us at Howden Re, to the extent that we could use AI or technology that allows us to more cheaply process stuff, great. Really the win for us is how do we use AI to take data that's available to us to make better suggestions to our clients as to how they can make more money.
And they're going to love you then, aren't they? You whisper in their ear and say, you haven't noticed that everybody who's really good at this is doing this thing we've spotted that no one else has spotted, but They've probably all done it by accident. They've all reached that conclusion independently of each other. But look, now you can see it. It's in the numbers because we were able to crunch these numbers, or we couldn't crunch them before because humans couldn't do it like me. Like the magic eye thing, we all get a headache and we all come up with different opinions. But actually the AI is better at that than we are.
I think that's right. I think it's our friend. I don't think it's our enemy. I think people are always going to be making strategic decisions. And I'm a full endorser of using the best available technology to allow people to make strategic decisions with the best available data set.
Well, Tim, I've really, really enjoyed chatting, as ever. It was far better face-to-face. I think anyone listening will have noticed. Is there anything that I should have asked you that I forgot to?
I think you got it, Mark. Honestly, like I said, I'm now a podcast listener, and I'm honored to be one of your guests. Because of your guests, I'm the least important and probably the most boring.
No, I don't think so. I don't think so. Well, let's people listening be the judge of that. and make sure we book you in to come on again. Thank you very much.
Actually, thanks, Mark.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.